watching Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head of Research, ICICI Direct. Very good evening, Pankaj, and welcome to the show.
Hi, good evening, Ritu.
Pankaj, a good day for you. I mean, you have been saying that markets will scale new record highs, and today in the pre-market session, we saw Sensex scaling to new record high. Nifty closes near 52-week high, tad short of a record high. So now, since the markets are at record high, and the beauty of the market this time is, Pankaj, that there's no euphoria also. There's no that, markets have, made new highs. Now what next? I mean, everybody is very cool with the markets this time. So what next?
So when you sort of look at markets, our sense is that Nifty will sort of continue to march towards lifetime highs, probably towards 18,800, 18,900 kind of a levels.
Hmm.
And I think, like you said, when you see the volatility this time is quite low, it's actually closer to 1 year lows. And not only domestically but globally also. So, which is why you don't see too much of a elevated anxiety at these levels.
Hmm.
And there's no major calls to sort of or major reversals expected in the market, or the overall risk in the market is sort of quite low. Uh, and our sense is that in this kind of a situation, since we have been seeing a key sector like sort of banking doing well, so probably that can sort of continue to do well. But our
Okay.
sense is that from now onward, some of the underperforming segments, it could be a smaller segment like insurance within the BFSI space, or cement as an overall pack, or IT. IT overall has been sort of beaten down significantly. So our sense is that some of these beaten down segments and sectors or stocks will do a catch up, while Nifty will sort of continue to inch higher.
Hmm.
So that way, I think the overall setup in the market looks quite constructive, and I think on any kind of a dips in any kind of a major or sectors or stock, I think is a decent buying opportunity. Our sense is that market can deliver good set of numbers going forward, though we haven't put it as of now. But our sense is that FY24 is expected to be a lot more better than what we have seen in terms of FY23.
Mhm. If we talk about this week, Nifty and Sensex rose by nearly 1%, but mid caps and small caps outperform. So are they doing a catching up exercise, and it's the right time to really enter into the quality mid caps and small cap stocks?
Absolutely. So when you sort of look at mid caps, it is down about 5% from its previous highs. The small cap is down even more at about 18 odd percent from its previous highs, whereas
Hmm.
Nifty is already in the vicinity or closer to lifetime highs. So, like I said, we would expect these segments to sort of do a lot more catch up, and this is what we have seen in this particular week. When you see this particular week, while Nifty is up about 1%, but the small cap is up closer to 2.5%, mid cap is up about 2 odd percent. So we are seeing catch up of all these sectors or segments which have not been really participating that well in the market. So I think this kind of a trend, our sense is going to sustain. I think IT is one sector which has managed to pass its 200-day EMA. So our sense is that we will not be surprised if it sort of delivers 10 to 15% kind of a return in the coming quarters.
Pankaj, if we look at the external factors like your Europe, Eurozone recession fears are still there, your US talks of recession are still there, and then you come to China where you have COVID rise again, and then lockdowns. Uh, so in this kind of a scenario where your government now puts off the rolls back the export duty on your steel exports, is it really going to help these companies to get into better margins and boost their exports, because export markets are really not doing well?
Absolutely. So whenever you see a bit of a downward revision in GDP, in fact, GDP numbers are expected next week. So obviously that kind of an impact is already there in the GDP numbers, and some of these sectors have been lagging for quite some time, metal in particular. And largely because if China is struggling with COVID-related cases, you are not too sure what kind of production or export they can sort of do going forward, and which is why the metal as a overall commodity is still soft. And despite the fact that the government removed export duty, did not help any of the steel companies because domestic prices are still 3 to 4,000 rupees higher compared to global prices, which is why the export also does not make much of a sense at current
Right.
levels. Probably it could
Right.
have help over a longer period of time, but which segment or the segment which will benefit is the
Mhm.
stainless steel players. So because both
Okay.
Jindal stainless steel and JSL Hisar, I think both of them are coming up with a capacity of about 1 million tons, which should get opened up in FY20 Q4 of FY23. And
Okay.
also the export market or export realization for them is better. So near-term volume growth plus the capacity expansion, I think both these companies will benefit from that aspect, and which is why we have revised their target there, and both are buy according to us.
Mhm.
NMDC it might help a bit, but since they don't export much, possibly possibility of the exporting arises, and which is why we have sort of turned buyer, or we have changed our rating to buy. But I
Mhm.
think the only winner of all this is the stainless steel players. Otherwise, the rest, like you said, it does not help much as of now for most of the steel companies.
How do you see sugar sector panning out? This sector has been lying low for so many months now, but now with the export being allowed by the government, what is the scenario that you see, and would you be a buyer in select sugar stocks?
Absolutely. I think we all know that the government had previously allowed 6 million tons, and companies have contracted for about 4.5 million tons. And now there is an expectation that they might allow 3 to 4 million tons extra because domestic production is good. We still don't have the recovery rates because crushing has just started. But our overall sense is that you will continue to see a decent amount of domestic production. And since global refined sugar prices or raw sugar prices are remunerative, so
Okay.
it opens up a decent amount of opportunity for a lot of these players. I think the better players to look at in sugar is Dalmia Bharat, where we have a target price of 490, and Triveni Engineering, where target price 380.
Mhm. Pankaj, we have this news just coming in that Adani Enterprises plans to raise 20,000 crores as offering the biggest FPO. The company will raise funds through further public offering of fresh equity shares. What would this mean for the markets and for the group?
See, for the market, in their weightage will sort of go up because I think that is one of the concerns people had, and that would sort of lead to better price discovery. I think the fundraising will also give us cues in terms of the kind of institutional money. I mean, at what levels they are comfortable putting or deploying money, because
Okay.
I think this is one stock which we also do not have tracked, and so fundamentally I can't really sort of give a logical explanation for it. But obviously it does
Mhm.
help in terms of a better price discovery in this one of the biggest Adani Group companies. And it does
Mhm.
help from the perspective that the liquidity also will go up, so probably weightages could go up. And if they continue to sort of come up with bigger plans and back it up, I think
Mhm.
it's good for the overall markets as well because of the private sector capex. I think Adani Group has been one of the most aggressive of the lot.
Let's talk about ITC related cigarette companies, cigarette stocks. I mean, cigarette volumes are back. They have surpassed the pre-COVID levels in first half of FY23. How do you see the cigarette companies, Golden Tobacco, ITC performing?
So I think cigarettes, the biggest challenge has been previously has been the volatile taxation, but last few years the taxation has been quite stable. COVID did
Mhm.
disrupt the volumes, but now, like you said, the volumes are higher than the pre-COVID levels. And I think there's some changes also happening since rural segment is witnessing bit of a slowdown. I think companies like ITC have sort of turned aggressive in terms of coming up with a rupees 10 price point cigarette, and which has found good volumes with them. And
Mhm.
which is why we are quite positive on ITC with a target price of 405. Obviously, the other segments are also sort of helping. I think
Mhm.
similarly, BST Industries has also introduced a cigarette at about 10 rupees price point. I think we'll
Mm-hmm.
watch out for some more quarters. Otherwise, it's a good company, has 70% kind of a payout ratio. Dividend yield is good. So
Mm-hmm.
if they are able to sort of garner good volume because of this, I think overall cigarette as a space can offer stable mid-single digit kind of a growth.
Mm-hmm.
And since it's a very profitable segment, so obviously it is going to help both the sort of companies. But obviously it's a sort of positive development, given the fact that taxation has been stable for quite some time. I think budget needs to be watched for this.
Mhm, mhm. Pankaj, not talking about the banking space and that particularly the PSU banks would not be nice. If you talk about the PSU banks, the rally continues, and this time it is PNB which is leading the rally in the mid cap PSU banking space. How do you like this space? And if you cover PNB, is it right time to really enter and buy the stock?
So within the PSUs, confidence in PNB is quite sort of lower. We would prefer with more of better names like say State Bank of India or Bank of Baroda.
Mm-hmm.
But yes, overall there are a lot of positive developments which have been happening and which is going to help this entire PSU a lot. One, I think the key positive is that the top management can be there for 10 years, which is what the government has clearly hinted about.
Mm-hmm.
Because that provides a good stability at the top and gives them ample time to sort of deliver. I think this is
Mm-hmm.
one of the biggest positives. And I think when we see tax buoyancy has been pretty good this year, and our sense is that if we don't see elevated levels of fertilizer subsidy, then overall, and if India gets sort of included in the global bond indices, then possibly the yields could soften, and that also can help PSU banks to sort of deliver better, especially in terms of treasury income.
Okay.
And most of the PSU banks are sort of trading attractive. When you look at the credit growth has been sort of good, so I think there's nothing much to sort of complain about there.
Mm-hmm.
So overall, they are entering next year in a overall good setup because they have already cleaned up most of their books. But having said that, I think we will still stick with tier ones because I think till the time juice is still there with tier ones, I think chasing smaller banks or even PNB, which had NPAs of more than 20%, I think
Right.
we will sort of not really catch or try to chase at this point in time.
Mhm, mhm. One other big news that hit the market this week was Tata Consumer is set to acquire Bisleri International. These are the news reports, not confirmed by the company. I mean, if that so happens, so what is the positive impact that you see on Tata Consumer?
So one is when you sort of look at the packaged water as a segment, you have 50% of the market is unorganized, and if Tata managed to sort of get Bisleri, I think
Mhm,
the overall fitment is quite good because both of them have got similar margin profile, and this will become a bigger segment for Tata under Nourishco. And obviously, Bisleri had a limited presence, and compared to that, Tata Consumer has a larger distribution footprint. So obviously,
mhm,
from that perspective, also it's a sort of a big positive for them. So I think if you look at combination of unorganized segment being large and Tata can sort of really scale up the distribution network, I think it's
mhm.
a sort of a win-win situation. And our sense is that three times a kind of a sales is really not a very expensive proposition from the Tata perspective.
Okay.
And which is
Coming
why
back, yeah. Yes, please.
we continue to like this stock with a target price of 950, and this is one of our top picks in the FMCG as overall space.
Yes, from last 1 year, I've been hearing from you that Tata Consumer is the best placed stock in the consumption space that one should really accumulate and accommodate for long-term good returns. Let's now talk about the insurance sector, which has now started seeing some traction because it was lying low. First, we had the banks, private banks, then we had the PSU banks, then we have NBFCs and insurance companies now seeing gaining momentum. So, what is your take on the insurance space and also on the NBFC space?
So when you sort of look at insurance as a space, this segment has clearly sort of underperformed, whether you look at life insurance or general insurance companies. I think when you see one, the growth had been sort of tapering off because you are coming from a high base effect because individual insurance, whether it's health or whether it is term plans, all of them had sort of taken a bit of a low a knock in terms of growth rate, and which is was one of the single biggest problem. The other thing is that companies were selling more of group insurance, which is not a very high margin kind of a business for them.
Okay.
Now, what will change is that in the second half, since people do a lot of tax planning and now things are sort of normalizing, so a lot of these segments will start picking up. And which is why we feel that overall, from a risk reward perspective, given the overall underperformance, what we have seen, I think these segments are looking a lot more brighter to us, because even in auto, our sense is that you will see sales picking up further going forward, and similarly for general insurance as well. And which is why we like SBI Life Insurance within the LI space, and in the general insurance side, we like Star Health, because health is one space where things are looking a lot more brighter, and so
Okay.
Star Health looks good to us in the general insurance space.
Let's now talk about the retail space in this festive season that went off, and now that we are entering into the Christmas season, retail has been doing quite well as far as the business is concerned, as well as the sales is concerned. So, what is your take on this space? Would you be a buyer in some of the good retail stocks now that demand is stabilizing and rural consumption is also seeing a pickup?
So I think one broader trend, what our sense is that there is a shift happening from the unorganized to organized, and which is why when you sort of look at most of the retail players, there has been a pretty healthy growth rate. So something like Titan or say Trent has seen 15 to 20% CAGR kind of a growth in the last 3 4 years, and the guidance also is on a similar line. They are doing one of the highest capex what we have seen. Some of the apparel companies, when you sort of look at ABFRL, what they are looking to do is that while their offline presence is good, the online as a channel is also sort of picking up for them, and which is why they've been acquiring D2C brands there. And that contribution is also sort of inching up for these companies. So both online and offline presence is sort of going to help. And like I said, this is one segment where we are seeing a structural shift from unorganized to organized, and which is why I feel that with the kind of capex being planned and this kind of a shift, all these are sort of, or this entire sector is becomes crucial from a portfolio performance perspective, and which is why we like the entire lot of be it Shopper Stop, which is looking to sell higher owned brands where the margin is higher. Trend is one company which is sort of doing exceptionally well. Last 3 year CAGR is 30%. Similarly, Titan, again, a big play. They've guided for about nearly what I call 20% kind of a growth rate by FY27 from current levels. So that's a pretty aggressive growth. ABFRL, I already highlighted, they're focusing both on the offline plus online D2C as a segment. And they have
Right.
also guided for about 15 16% kind of CAGR kind of a growth. So I think all these are portfolio stocks, and the retail as a segment looks or is set to become big according to us.
Now, let's talk about the hidden gem. So, which is the stock that you're going to talk about today, Pankaj? I think it's something to do with the capital goods space, right?
Actually, it's cement. So cement is one sector which has been sort of beaten down, hasn't seen the kind of recovery. So while broader markets are doing well, I think this is another space which should do some bit of a catch up. We have already seen the worst of cement sector in the last quarter. Now things should improve. So the stock which I am recommending is JK Lakshmi Cement with a target price of
Okay.
780. This company has got a market cap of about 7,800 odd crores. So this company has got a capacity of nearly 13.5 million tons, including subsidiary, and is a dominant player in the north and the central region. And these two regions typically enjoy decent demand. The growth volatility is less. Their capacity utilization is already 90 odd percent, and they're looking to sort of expand their capacity by 2.5 million ton with a capex of 1650 odd crores. And
Okay.
they're also looking to sort of generate more of captive power so that they don't have to buy costlier grid power. And I
Okay.
think our sense is that overall lowering of the cost and plus the capex expansion I think their EBITDA per ton should improve. So last quarter it was 600 rupees per ton. Our sense is that for a blended year, it should be about 805 and closer to 1,000 rupees in FY24. And
Okay.
good part is that when you look at these cement companies, they're available quite cheap at about $69 per ton, far more lower than the replacement cost. So we
Mm-hmm.
valued at about $80. And I think even the longish plan is to sort of double their cement capacity to 30 million tons by 2030.
Mm-hmm.
So I think this is one sector which should do catch up, and JK Lakshmi Cement within that has got a healthy balance sheet. Capacity utilization is good. Capex plans are in place, and so that way our sense is that it should inch closer to the replacement cost of the cement. So from that perspective, we feel that a bit of a catch up overall can happen, and which is why we are recommending this stock.
Mhm. Pankaj, as we move closer to the budget now, because 2 months, nearly 2 months left, we are again seeing activity happening on the disinvestment front. So today we had a news that government might go for, selling stake in companies like Coal India and further divest. So would you be, focusing on such companies which is in the list of divestment by the government?
So I think the only company where we are sort of focusing a lot more has been Concor. So this is one company which we feel should get or should capture good global interest, both global and local interest. And this
Mhm.
is one company which has been doing significant amount of capex and is a very important sort of a overall company. If somebody has to play a big role or is looking at the logistic as a big opportunity. So probably this year divestment will not happen, but our sense is that next year this will be one of the prime candidates to get divested.
Mhm.
Otherwise, you sort of divestment overall this year is slow. Even IDBI looks like
Yes.
that will happen next year only. So
Mhm.
while a lot of groundwork will happen this year, but I think next year probably is going to be a lot more exciting from a divestment perspective.
Mhm. So, Pankaj, what will you do next week now? Because that is going to be a crucial week ahead of the RBI policy that we have in the first week of December.
So with markets at new high, we would expect underperforming segments like IT, insurance, mid caps, small caps, cement to sort of do catch up, and Nifty again will have its own sweet pace to reaching new highs of 18,800 to 18,900 kind of levels. So one should stay put in markets and probably increase overweight in some of the underperforming segments.
Pankaj, thank you so much for being with us and for your views on the markets.
Thank you so much, Keith.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.